In this video, I'm going to talk about the various assertions that management makes about classes of transactions and events. So let's start with occurrence. Did the recorded transactions actually take place? That's what occurrence is all about. For example, if the company is saying, hey, on the last day of the fiscal year, we made a $50 million sale. Great. Did that actually happen? Did that actually occur? Or is that just a fictitious transaction that management made up and it didn't even happen, and they just made it up to make their earnings target? So the concern with occurrence in this assertion, if you're the auditor, the concern is that there's overstatement. Okay, overstatement is, did the company overstate their revenues by making up fictitious transactions? Now, completeness, we're looking at the opposite. With completeness assertion, we're saying maybe there's an issue with understatement. Instead of overstating an account, maybe management understated the account. And we want to know, were all the transactions that should have been recorded during that period, were they in fact recorded? So this is complete. For example, did they record all of the liabilities that they should have recorded? Why? They might have an incentive not to record all of their liabilities, to understate their liability. So we want to not only know, okay, did transactions occur and see if they're overstated accounts, but we want to know, is there complete? Have we recorded all of the transactions? Now, with authorization, this assertion is about looking at the various transactions that took place and saying, have they been properly authorized? For example, let's say that there was a transaction where there was a stock grant of $100 million of stock to the company CEO. Did the board of directors actually approve that? Okay, so that would be the authorization assertion. Accuracy has to do with the actual amounts from the transactions. For example, let's say during the period, at some point, there was a journal entry. The company ended up writing down its inventory. It said the inventory was impaired, and they had this $80 inventory write-down. Is that the correct amount? Okay, maybe it wasn't supposed to be $80. Maybe it was supposed to be $100. Or maybe it was supposed to be 50. Where did they come up with this number? How did they get that number? Was that the actual correct amount of the inventory write-down? Cutoff, when we're looking at the cutoff assertion, we want to know about the different transactions that were recorded. We want to know, were they recorded in the right time period? For example, when we think about sales, when we think about sales revenue, so let's say that the company is on a fiscal year that begins on January 1st and ends on December 31st. And so if we look at 2019 fiscal period, so we start on January 1st and we end on the 31st of December, we want to make sure that for this period, when they put together the income statement, all the transactions that they recorded, all the sales that they recorded during this time period are 2019 sales. Okay, 2019 sales. And you say, duh, that makes sense. Of course, it's 2019. But what happens sometimes, so let's say that it's December 31st and the company is having a hard time. They're like, oh, we're not going to meet our earnings target or our sales target. What they might do is they might hold open the fiscal year end. They might extend it into January 1st or January 2nd and allow those sales, which are really supposed to be sales for 2020, they'll record those for the 2019 fiscal year, which is not correct, right? That's obviously this past the cutoff period. So the auditor wants to make sure that there's no 2020 sales that were included in this time period. So that's what cutoff is about. Classification, with this assertion, we want to know that for the transactions that were recorded during the period, did they go to the right accounts? Now, a good example of this is the fraud that occurred with WorldCom. Okay, WorldCom had line costs, and the line costs were supposed to be expensed immediately. So they're just supposed to be expensed. But what WorldCom did was they're actually capitalizing those costs, making them an asset and expensing them over time. That was not the correct treatment. They should not have been capitalizing these line costs. They shouldn't have been accounted. So even though they had recorded like transactions for the line costs, they were not putting them in the right accounts. They should have been expensing it immediately. Instead, they were booking it to an asset account. The presentation assertion has to do with the transactions that took place during the period. Were they correctly aggregated or disaggregated? Were they clearly described? And when we look at the notes, to the financial statements, are those easy to understand? If you're an investor and you're looking at the company's notes to the financial statements, do you understand their revenue recognition policy? If you look at any company, you look up their 10K for like a publicly traded U.S. company. In the notes, the financial statement, they'll always have a thing about accounting policies, and they'll talk about how they decide to recognize revenue. And so you can look at their revenue recognition policy. Also, the company might explain in their notes that they have, say, have credit sales. They talk about how they estimate bad debt. How do they estimate uncollectible accounts? Okay, so they should be very clear about this. The whole idea of the financial statements is that an investor will be able to look at these financial statements and clearly understand what is going on, what are the accounting policies, what's going on with these transactions.